It was the FCA which has banned the sale of crypto derivatives. Welcome back to Renegade Investor Academy. As you can see, there's no expense spared on this channel. We've upgraded to this magnificent whiteboard so I can share even more with you, and you can even see it on your phones. Now, at the risk of putting you off investing forever, on this episode, I want to take you through a whistle-stop tour of 12 different kinds of risk that we need to take into account when we're making our investment decisions, our allocation decisions across different asset classes, different countries, geographies, whatever. Now, don't be put off by all this, because I will go into more detail on this in a new series I'm launching called Renegade Investor Revolution that kicks off on the 10th of March. But what I want to do today is just give you a flavor of some of the things that we need to take into account. So let me start rattling through them. So geopolitical risk. We all got quite familiar with this over the last 4 years when we had a president who was getting into some trade wars with China, competitive tariffs going on. You could argue that some of this could be happening in the post-Brexit world in Britain, where we're already seeing some things that are becoming more difficult, import procedures, export procedures, and perhaps bringing some new costs with them, possibly some unexpected tariffs as well. So you've got to understand where you're investing in the world and how might they be impacted by anything that's going on at a kind of big political level between the powers that be, and how might that result in sanctions, trade tariffs, etc., that could add or hinder the progress of trade between those countries. So geopolitical risk is definitely one thing to watch out for. Another is regulatory risk. In other words, changes brought in by the powers that be, which have an impact on your investment world. So one good example of this recently was the FCA, which has banned the sale of crypto derivatives in the UK. So if you were hoping to spread bet on Bitcoin or Ethereum, or you want to buy futures or options that relate to cryptocurrencies, you simply can't do it anymore. There are some countries where we've seen short selling being banned. And after all the recent dramas in America with the Robin Hoods versus the hedge funds, who says that we won't see even America perhaps looking at some kind of ban or limit on short trading? So these are the sorts of things that can come out of left field quite quickly and can turn a bad investment strategy into a good one, or vice versa. So you've got to keep an eye on what's happening from a regulatory perspective. Now, if you saw my recent episode on how to value shares and how to value stock markets, you'll know that there's a valuation risk. So when you start looking at Tesla having a price-earnings ratio of 1600, that should tell you something about whether you want to join that particular party, and whether you think it's going to go on and on into the future, and therefore you want to be a part of that. But knowing the value of what you're investing in is key, because if you listen to a lot of the kind of long-term successful investors, it's almost like they make their profit up front when they buy the right things at the right price. And anyone can jump on a bandwagon that's been going for 5 or 10 years, but spotting that share, that company, when it was at a point of maximum value, and then riding that crest all the way up is obviously how they have historically been hugely successful. So am I paying a fair price for this asset is one of the things you have to ask yourself. You've got to have some kind of unemotional way of understanding that, because we all have a kind of a herd mentality. We love to follow the crowd, and if everyone keeps saying, oh, this is a good thing, this is the next whatever, Google, Amazon, Facebook, we love to pile into those things. But sometimes you have to remember a saying that I heard a long time ago, which is that the majority is always wrong. And if you think about it, the majority of people are not successful. They're not financially independent. They're not necessarily life's winners. So, think long and hard before you simply do what everyone else is doing. It's not always the best strategy. Another thing to look at is liquidity risk. If you're a property owner, a property investor, a buy-to-let landlord perhaps, you'll know all about liquidity. The perfect liquidity is something where you can buy or sell at the click of a mouse in a nanosecond. You're in or you're out. And you see a lot of that on, say, the foreign exchange markets, which are the biggest market in the world. Trillions of dollars of value every day, bought and sold, bought and sold. At the other end of that spectrum is something like property, where you might decide to sell a property today, and it could be 3, 6, 9, 12 months before the whole transaction completes. Meanwhile, you could have missed the boat on something else because you didn't have the cash, because you couldn't sell the illiquid asset. And similarly, when you get involved in long-term commitments, clearly there's no liquidity there. Oftentimes these things can't be traded at a click of a mouse. They can't be transferred to someone else. So part of what you're looking at when you look at the return from an investment is, am I comfortable with the liquidity or lack of liquidity that is effectively embedded within that investment model? So oftentimes, I think the inverse almost of that is the kind of over trading risk, because most of us tend to not do the smart thing, which often is to do nothing. So, buy and hold often turns out to be a better strategy than jumping in and out, trying to time markets at the high or the low. It's often best just to make an informed decision, commit to something, and then watch it over a number of years and see how it goes. So liquidity is another factor you've got to consider. Correlation risk. This is something that's becoming, I think, increasingly challenging, because there was a time when various different asset classes all moved in different ways, and portfolios were built on the idea that you'd have some stocks, some bonds, some cash, some precious metals, and at any one time, some of them would be up, some of them would be down, and overall, you'd get a better result than if you just concentrated in one asset class. What we've seen in some of the more recent crises and turbulent moments is that everything goes down at the same time. If you look back to March 2020, as the full scale of the pandemic became obvious, then all the markets crashed, the stock markets, the bond markets, the gold price, even Bitcoin. So all of these things went down enormously. Now, if you do a longer term analysis, it still holds true that some of these things are less correlated than others. So for example, Bitcoin tends to be nothing like as correlated to, say, the stock and bond markets as they are to each other, or even as gold has proved to be recently. So if you can have uncorrelated assets in your portfolio, then you can reduce that risk of everything going down at the same time. And it's quite a healthy objective to want to build a balanced but also an uncorrelated portfolio. It's also one of the reasons I talk about global diversification, is to get exposure to other markets, because there's usually somewhere that's up when somewhere else is down. And one of the best performing stock markets in the last few years, would you believe, has been Iran. Now, it's not easy to invest in the Iranian stock market, but all I'm saying is, if you were worried about what might happen in the British or the American stock market, having some global exposure into some of these emerging markets, some of these frontier markets, that could actually give you a better lack of correlation risk, because they won't necessarily move in exactly the same way as the established Western markets. If you're a longer term investor in things like bonds, you need to watch out for reinvestment risk. This is something that a lot of financial institutions are now finding. If they've been locked into 10 or 15 or 20-year US Treasury bonds, for example, back then they actually paid some interest. You could get 5, 6, 7, maybe double figures, 10% interest on a long-term government bond. Those are coming to an end. Every month, every quarter, every year, these bonds reach their expiry date and that bond disappears. So the question then becomes, okay, you've got your capital back. What do you do with it? Where do you invest it now? where else are you going to get that 5, 6, 7% return that you got 10 or 20 years ago? Certainly not in the US Treasury market. Certainly not in any kind of cash or cash deposit type market. They're all at fractions of a percent if they're positive. Many of them are negative. So the risk is, okay, I've got the money back. What do I do with it now? And that's something that you need to manage in your portfolio, looking at ahead what things might be maturing in the coming 12, 18 months, and what would be my plan for how I'm going to redeploy that capital to best effect. Something we've seen a lot of in the American market and the tech sector recently is concentration risk, where a lot of the growth, a lot of the success is concentrated in a very small number of companies. Think obviously of the FANGs. If you wanted to make serious money over the last 10 years, you just needed to have invested in those technology companies, and you had a stonking return for the best part of a decade. But times change. Will they still be the stars of the 2020s? Will some other tech companies come up? Will some other sector emerge? Who knows? But if all of your savings, all of your investment is concentrated in a small number of companies or in one asset class, a lot of the people we talk to are very heavily committed to property, to buy-to-let residential property, for example. If you've got a lot of your wealth in that single asset class, you are very exposed. And as we've seen, again, one of the side effects of the pandemic has been more pain for landlords, either with people not paying their rent or moving out to the countryside. We've seen inner city rents plummet during the last 12 months. So, again, this links to a liquidity risk. If you've got all your money in property, you've got concentration risk and you've got liquidity risk. So again, these are the things you have to balance as you structure your investment portfolio. One of the things that often gets forgotten is what I call execution risk, which is to say, can the company and the team that I'm investing in deliver on their business plan? So take the technology sector again. Clearly, there are loads and loads of new players coming into that. Some of them will become the next FANGs. Many will disappear without trace. And it's not necessarily because they have a shortage of money. It's often because they fail to execute on the business plan. The people simply aren't good enough, whether it's the product, the marketing, the distribution channels, the follow-up, the customer service, whatever. There are winners and losers based on their ability to execute on the plan. So how good are the teams that you're investing in? What evidence do you have of their execution capability? And when you're rebalancing your portfolio and deciding what stays and what goes, maybe you need to look at those that are delivering versus those that are not when you decide who stays and who goes. Central bank risk. Where do I start on central banks? We have been in this enormous experiment at least since 2008, arguably since the Bretton Woods post-war. Now it is the norm to be printing vast quantities of new currency, to be monetizing government debt. We're seeing less and less independence of central banks, closer and closer ties with the government. They're becoming an arm of government policy. And I think monetary policy and fiscal policy are going to end up being merged into a single kind of overall thing, of which historically the central banks have managed monetary policy, which is effectively interest rates and the money supply. The fiscal policy is things like tax rates and government spending, and they're all increasingly looking to be merged and possibly even into the digital world of central bank digital currencies. Again, I've done other episodes on that. There's a lot of issues there around behavioral economics, around surveillance, around control of our lives, our behavior, our movements. So again, you have to keep an eye on central bank risk and say, okay, how is my portfolio going to cope with that kind of impact and that kind of risk? Because risk itself really means, what are the chances of a bad outcome? I think it was Charlie Munger, who's Warren Buffett's right-hand man, who said, if you can't stomach a 50% loss or 50% drawdown at least once or twice in your investing career, you shouldn't be investing in things like stocks and shares. But I think we also need to separate volatility from risk. Just because something is volatile, which just means its price moves up and down a lot, doesn't necessarily mean it's more risky. It can mean that you need perhaps a stronger constitution to invest in it, but it doesn't necessarily mean there's likely to be a worse outcome or an increased likelihood of a worse outcome. And probably the best example of that is our new best friend, Bitcoin. If you look at the history of Bitcoin, it's been ridiculously volatile. It goes up or down 8, 9, 10% in a day. Those are normally regarded as annual movements in share or bond prices. But if you look at it across a decade now, it's doing that. It's always going up. And somebody who'd invested at any point in the cycle thus far would have made money. So even though it's crashed and burned in 2017, it crashed in March of 2020, it's bounced back so strongly that anyone who'd invested at any of those previous prices would now be ahead of the game. Obviously, past performance is no guarantee of future performance, but it certainly has been very volatile. Now, in a normal market, by which I would mean, the main stock markets or the bond market, one of the aspects of volatility that you have to think about carefully is if something goes down, how much does it have to recover to get me back to where I was? And there's often a fundamental mathematics error in that I'd like to try and just correct today by looking at this table on the right-hand side of the chart. And this is about what percentage it takes to recover from a loss. So in the red figures on the left-hand side is the loss, and in the blue on the right is how much it would have to go back up to get you to where you were. So if a share price goes down 5%, it only needs to come back up 5.3% and you're back to breaking even. 10%, it needs to go up just over 11%. 15%, it's 17%. Now it starts to get a bit more interesting. As we get towards a 20% fall, it now has to go back up 25% just to get you back to where you were. If it goes down by a quarter, it needs to go back up by a third, 33%. To get you back to break even. 30%, it has to go back up nearly 43%. 35%, we now have to go up more than 50% to get to where we were. 40%, it's a 2/3 gain needed, 66%. And by the time you get to a 50% loss, you actually need to double in price just to get back to even. If you think of it in round numbers, if the price was 100 and it comes down to 50, a lot of people would say, oh, if it goes up 50%, I'm okay. No, you're not. That'll only get you back to 75%. To go back to 100, it needs to double in price. So you've got to be very careful when you see a drawdown like this, the actual amount of recovery needed to get back to where you were, let alone make a profit, is quite substantial. So it's worth just bearing those numbers in mind, particularly once you start getting above a 15 or 20% drawdown, there's a substantial amount of recovery needed to get you back to where you were. Probably one of the most challenging aspects of investment to think about where we are today in 2021 is the inflation or deflation risk. Broadly, do we think prices are going to go up? Or do we think they're going to go down? And as I've talked about this in the previous episode, there are so many factors that influence inflation or deflation. And there are broadly two main types of inflation. There's asset price inflation and there's consumer price inflation. And one of the impacts of central bank risk with all the money printing is that we get asset price bubbles. That's why the stock markets keep going up. That's why price of artwork or classic cars and some kinds of real estate keep going up. But then you've got deflationary pressures like the economy being shut down during lockdown. New technology tends to have a deflationary effect because it makes things faster and cheaper than they were before. Maybe it cuts out human beings from a process that becomes done by a machine 24/7. So as we get more into artificial intelligence and robotics, that's actually deflationary for the overall economy. But as we get into all the money printing and more money chasing fewer and fewer goods and services, that's inflationary. The rising trend towards nationalism and cutting out global supply chains is actually inflationary. People will pay more for a local made product rather than always going for the cheapest thing that has to come halfway around the world. And so that again could start to cause consumer price inflation. But the biggest driver for that will actually be wage growth. Because for all the asset price inflation, for all the money printing, wages have been really stuck for about 40 years now in Western economies. And that's one of the underlying drivers of this wealth gap that's behind a lot of the social unrest we've seen recently. And that's not a problem you're going to fix quickly, although the aging population demographic does mean that we, at some stage, will have a shortage of workforce. We'll have a smaller workforce that may effectively recover its bargaining position to actually get higher wages, and that could then trigger consumer inflation. So really, at the moment, your portfolio has to be able to cope with either outcome. What you do not want is a situation where you'll be destroyed by inflation, or a situation where your wealth will keep declining and your purchasing power will keep declining through deflation. So again, one of the things we'll look at in the Renegade Investor Revolution program is how to get that balance between assets that will help you in an inflationary world and those that would help you in a deflationary world. And then I guess we can all point to and recognize the final one I want to share with you today, black swan risk. In other words, some completely unexpected event comes out of left field and has a significant impact on your portfolio. And there was all sorts of lessons, I suppose, looking back that we can learn from the pandemic. One obviously was the need to be diversified across lots of asset classes because not every class was impacted the same. I think another is an emotional one to avoid panic, because a lot of people sold out at the bottom in March and missed this massive recovery. I think we've all been staggered by how the markets seem to have been disconnected from the real economy. But the point is they're always forward looking. They're always looking beyond what's happening at the moment. The first thing they saw was infinity Fed, back to our friend central bank risk. The second thing they saw was a very quick development of vaccines. So those two bits of good news as far as the stock market is concerned meant job done. We're sorted now. So people that sold at the bottom because of this black swan have missed out on an enormous amount of growth. And because of what I said here about recovering from a loss, prices went down in the stock markets 35 to 40%. They're going to have to go up again 60 or 80% from when they come back in to actually get back to where they were. And of course, we've had that initial surge now. They've missed that. So the question now is, how long will it take for anyone that suffered that kind of loss to get back to that position? And that's actually an introduction to the topic that I want to go on to next time, which is probably one of the least understood aspects of risk, and it's called sequence risk. So thanks for joining me now. Please do like and share these videos so we can get them to more and more people. And if you want to go and pre-register for the upcoming series I'm doing, just go to renegadeinvestor.com, pop your details in there, and I'll see you next time for another Renegade Investor Academy. Thanks for watching. Thanks for watching. If you'd like to see some previous episodes, click here. Don't forget to like the video, subscribe to my channel, and ring the bell so you don't miss out on any future episodes.